All right, good morning, everybody. So the trade war has begun. If you were trading in the last Trump administration, you'll remember a war that he started with China back then. Uh, it it sort of kicked off in January 2018, and it wasn't that bad. And everything that he put on back then has been ongoing since then. Like there was a little bit of disruption, some supply chain issues at first, washing machines and that sort of stuff, but it normalized after a little while. Once the market gets done with the shock of it all, you know, then we get the normalization that begins. So, just take a deep breath with all of this. Some of these are just negotiating tactics. Some of it is because of the US and its issues, right? We got a lot of issues with the Fed, and I'm going to show you some charts. The treasuries, our our interest on debt, our debt itself, and that's one of the big issues, right? It's trying to get things under control and get some money in and start paying down that debt. All right, so it's not just about fentanyl or the borders. There's a larger underlying issue to all of this, and the idea of the U.S. needing to service its debt before really bad things happen, right? So don't let the bobbing head media throw you off. Looking at what we've got going on this morning, Japan up 0.25%, small caps in the Russell down more than 2.25%. If you looked at the COT report over the weekend, it's record levels of short in there. NASDAQ down minus 1.8, S&P minus 1.6, and the Dow about 1.5 to the downside. Everything else just sort of normalizing between there. We're going to get some data this morning, manufacturing PMI, some construction, ISM manufacturing, and auto sales. With the auto sales today, watch for any language, right? If they do any sort of announcement, watch for GM, Ford, Stellantis, all those guys. They're going to be getting hit hard. And of course, they're going to try to tip the scales, chip teeth, shock the market, say negative things, negative projections going forward. It's really kind of freaking people out. It's going to be this way all week. If you look at the data that we have coming in and try to concentrate on the different data that we now are finding is relevant, right? We've been focused on anything that would affect the Fed raising rates, cutting rates, holding rates steady, and of course, job numbers, which goes right to the heart of that. So interest rates, inflation, job numbers, that's generally what we focus on. Now we're going to be focusing a lot on supply chains, goods over services, manufacturing, forward earnings. And a lot of the data that we're going to get this week goes to the heart of that. And then, of course, the strong, quote, strong consumer, and how strong is that consumer. Wouldn't be surprised if we start hearing more about the depleted savings accounts of Americans and, skyrocketing credit card debt, higher rates on those cards. Anything that they can do to portray this as negative as possible. So at 9:45, 10 o'clock, then we're going to get some auctions, 11:30. We got some Fed members chipping teeth. So we got Bostic and a few others. Just keep in mind, if we have auctions at any point today, 11, 11:30, or 1, just assume that the other two do as well. We have auctions today at 11:30. So just assume that 11 and 1, there will be auctions as well. We go through multiple sites every morning looking at the different events that are on the economic calendar. And even with these multiple sites that we're looking at, you'll never catch them all, right? Never. One of them that isn't on there, and it kind of highlights this fact that I continue to put out there, is that just because it's not listed doesn't mean that there isn't a big economic event, something that comes around every quarter, every month, every year. And you may be thinking, well, so what? If it's not listed, it probably isn't all that impactful or all that important. We're going to get the start of the numbers for QRA today. QRA is a two-part event. We'll get the first part today, the proposal, and then on Wednesday, we'll get the other part, the actual numbers, and it goes right back to how we're going to deal with the government. So QRA, quarterly rebalancing announcement or refunding announcement, you can say it either way. And it's Scott Bessent taking the place of Janet Yellen, who's going to be doing it for the first time today. Hopefully, you know, he took pointers. He understands what the heck he's supposed to do and he doesn't screw it up, right? All it takes is for him to say something out of context or for a reporter to quote him out of context, and the markets are going to get really violent. It should be this afternoon when we get the first part, and then on Wednesday in the morning, we would get the second part. So around 8:30 Wednesday, I would believe, is the second part, and probably 2 o'clock today, right? But you won't find it listed here. You can go to the federal government's website, search around for QRA, probably find the announcement buried in there somewhere, and 2 o'clock sounds right. Memory serves. What we're looking at right here is a stock bond ratio, right? So don't worry about the name that you see in the top. I could put anything up there. It wouldn't affect this. What this is looking at is SPY versus TLT. Now you can do it a lot of different ways. You can use, you know, SPX and ZB, ES and ZB, a lot of different ways, but it's stocks versus bonds. So when you have a ratio chart like this and you have two names, when the index that you've built is going up, the first name is in control or doing better. And when it's going down, the second name is in control or it's doing better. So we can see that we've got a significant issue here when we compare stocks versus bonds and how just out of control and ballistic the stocks are versus bonds. And it goes back to first we recovered out of COVID, then we ran up and broke out. We've just been, you know, on a tear since then. But this is a part of the issue, right? So if we see bonds starting to catch up and stocks starting to catch down, then we would see this begin to normalize, readjust, you know, kind of come out of this completely parabolic chart that we're in. I made this with an indicator. If you want to do it yourself, the indicator is called the price ratio. You can just search for it on Thinkorswim, type in the word price, you'll see it. And when you open it up, you put your first name in the top one and your second name here. And then, of course, you can change the moving averages. Now, I just color code it to where it's white. Depending on your chart background, you know, you make it something different. We did get the AM edition right before I started, but I haven't had a chance to read it yet. So while I can share it with you guys, just keep in mind, I haven't read it yet. So you'll have a chance to take a look at it. there may be some clues in there about well, there's not. I just scrolled through it real quick. All they have is key dates and that they're going to go to risk off if the SPX is under 6,000. That's all they had in there. Short and sweet on the founder's note today. And we are in negative gamma, minus 0.6. All right. So the gap is pretty clear. That leaves us a target to aim for. Right now, we're developing a little bit of an island. It is a pattern called the island reversal. It can be a bearish island or a bullish island. If you've read the book Hit and Run Trading, I think they have something like Gilligan's Island in there. So it's a pattern that's been around for a long time. Various traders have come up with different styles to it, but the idea is now that we've gapped down and we're holding within this base, as long as we don't break the base to the downside, then we could gap back up again. Not rally back up again, gap back up again. That, of course, would mean that we stay in this range all day. We can wick out a little higher or wick out a little lower. We just wouldn't want to see it break down from here and actually begin legging lower or begin running back up to close the gap. So it's an island reversal setup at the moment. If we zoom out to last week, Monday's range, which is the candle of control that we've talked about last week, we broke out of it to the downside overnight, right? So we wicked out and we've come back in again. That candle is still the candle of control this week. Maybe a little easier to grasp on the daily. There's Monday's candle, right? So that's still the boss. And it's not just on the ES or the SPX. You know, look around in whatever it is that you want to trade. Find that Monday gap down bar and then work off of that if it's applicable. So that puts 6026 in focus as the halfback that we have to get through. $59.81 is the 786. Now, what I just did here by flipping that around and putting the 786 down here is if we think about an hourly chart for an example, and how this can be defined as my bear flag, my failed bear flag, if we get it. So there's the flag pull. And even if we just discount all of that for a moment, this would be the flag on that pull. And that's the 786 level that we have to get above if we're going to come up here and challenge that half. 59.80. Otherwise, if we can't get above this 786, then we're going to test lower levels, the 111 first, and then the 1236. Now, this almost feels like cherry picking, right? Like I went in and specifically targeted a certain spot, because this isn't the time frame that we're using, right? It would look that way if I went to something like a weekly too. It wouldn't make sense. Go to a daily and it makes sense. As we measured Monday's candle, I didn't cherry pick a high and a low spot just randomly. I chose a particular candle. That's it. It's the dominant candle of control. So we have to get above 59.81. That's the line in the sand, and begin working our way back up, or else. $59.30, which is a cog line, and then 59.11, which is also a cog line. It's 59.32, 59.11. Those are the lower levels in focus if this doesn't hold. And we're underneath the put wall, which is lined up at the halfback. So if we do try to rally back up today, that's 2 levels of resistance between the halfback and the put wall. Then we've got the 10-week moving average, the 3-week moving average, the 10-day, the 20-day, zero gamma volatility trigger, everything over our head, right? We found the lower edge of the ADR already. If we hit one edge of the ADR early enough in the day, we can go to the other edge by the end of the day, just on the normalized way that markets move. You may see that as bullish. I wouldn't necessarily. Right? Like if you push a swing, at some point the swing is moving up, and at some point the swing is moving down. So depending on when you look at the swing, you may say, oh, well, look, it's going down. Or, oh, yeah, look, it's going up. But it's really not going up or down dominantly. It's going up and down relatively equal. That's what the daily movement of a market is. Some to the upside, some to the downside. And if we do close higher than the previous day, we still went down some. A lot of times. That's just the way it works. So we hit the lower edge. It's possible we could hit the upper edge. But to be fair, I've seen it hit one side, then the other, and back again like a ping pong in the same day. Whether it hit the upside first and then the downside and then the upside again, or vice versa. Also, it stalled against this open. And if it was going to hit one side early and then go to the other side by the end of the day, it needed to get through this level. And it set a new high, so that was a good start. But then when it pulled back and it retested that liquidity, we couldn't get an equal high and we couldn't get a new high. And now we're getting a lower low. China's still closed. They're on national holiday. It's their new year. They'll be back on the 5th. They're closed until the 4th. So we don't even have the negative impact out of China yet. The floor pivot and the weekly floor pivot are over our head. It's a long ways off. We're not too far away from the weekly. If we're looking for any sort of mean reversion or anything like that, we don't have it. If we were to focus on the daily, maybe, put in something like the R1, R2, S1, S2, we're already below the S2. If we break our own Globex low, then we'll challenge S3 5911 cog line. Which would be, if we measure everything that we have so far, this little island, it would be 50% of that to the downside. Otherwise, if we can break our own Globex high, we got to get through this S2, then the cog line at 6032, which is S1, then back up to the daily floor pivot. We have a point of control from January, looks like the second week in January, from the 12th to the 17th. That point of control is 59.86. It is the upper edge of our Globex range right now. So that's going to act as a significant level of resistance as well. We're just stacking them up, right? One on top of another on top of another. As you can imagine, we got a lot overhead that we got to fight through if we're going to try to work our way back up. We don't have a market maker move this morning. They're not hedging. Or if they're hedging, they're not hedging very much. So you want to continue to watch the front expiration in the options to see if this 18.76 gets higher than the 20.06. If that front number gets higher, then we have a market maker move, and that says they're hedging. When we come in and look, generally when we see that hedging, we see thousands here, like we do, just like this, individual strikes with thousands of contracts. And we're seeing it on both sides. I think it's likely the reason that we're not seeing the market maker move is because they're spreading it out into multiple expirations. So, you know, if they only bid up the front one, which is what we see on economic event days, say they're worried about CPI, they'll go in and they'll bid that day. But if they're spreading it out along the entire options chain through the week, then they're raising all of them. And that's why the front isn't standing out with a market maker move. We can see here tomorrow's expiration has thousands of contracts traded, not as many, but there are strikes in the thousands. Just keep your eye on it because it is getting the attention that we would spot and call hedging, but it's just not popping that label yet. 10-day, 30-minute volume profile with TPO. We still have a misalignment between the TPO and the volume profile. We're not going to see this point of control move anytime soon unless we pick a spot and stay there and digest long enough to move it. Even the candles that created the location where we're at, right? We got some here, here. We won't see that for days yet, right? We've got to get through today, which would take out that day. Then another one, 2, 3, 4, 5. We've got at least a week. We'd be in next week before we would start to take these out. Right? So maybe Wednesday or Thursday, we would start hitting these candles. So the only way that point of control is going to move anytime soon is if we fall down into an iceberg or we pop up into a ceiling and then stick the landing and digest that enough to move that point of control. All right, well, it was hit, but we didn't digest through it, so I'm going to keep that on there. That's the January 24th VPOC line. 61.47.75. I don't think we're done with it. We'll keep it on there. But we got a new one that we developed on Friday. So that's interesting to think about. When we dropped down Friday afternoon, right, into power hour, we spent 1 hour down here and we put in more volume in that 1 hour than we did anywhere else in the entire trading day. 60.65. So any move to the upside, we have to get through that point of control. That's what it looks like when you hit an iceberg, right? We dropped down and found a lot of liquidity down there. It's interesting to note that it wasn't at Thursday's lows either, right? It was off the lows. It wasn't a solid round number like one of the options levels, 60.50 or 60.25, 60.00. It wasn't anything like that either. I have to move it down a little. It's a little off. Now this morning we've got a classic D-shape distribution. That's about as good as it gets in the textbooks if you're looking for just your normal distribution curve. It kind of reinforces the idea that we're going to hold the line here for a little bit. The point of control could be a little more centralized, right? We don't want it too heavy on the top or too heavy on the bottom, but otherwise, it'll do it. It's all right. So not a lot of insight here. Watch when we do check the edges that we don't get a very large volume spike up there. What we call a volume shelf or a high volume node. So we are back down below the 10-week. Not extreme. We've seen lower than this even just last year. We're not yet minus 1% below the 10-week, but more than 0.5% moving in the downward direction. It's a little bit of a correction to come back to the 10-week. I wouldn't start to get concerned until we get, say, more than -2, say -2.5, then I'd get a little concerned. This big negative area back here is that bear market in 2022, right? And obviously we were hitting, like -8, -6, -4. We're nowhere near that. All right, looking at the 10-day, we're not quite 1.5% below the 10-day. And between -1.5 and -2 is about where we look to correct. So we're going to look to correct from the correction down with a move back up. That's double negatives. Yeah, I could just that'll hurt your head. We're just looking for a little bit of mean reversion if we get below this 1.5 and start moving towards this -2. So we're talking about a 2% move away from the 10-day moving average would likely cause a reflexive move back in the other direction, like a dead cat bounce. Looking at the weekly expected move, remember on Friday we were looking at this, and of course Friday it's not set in stone, so we're only looking at a glimpse of what it could be, but it was pretty much in line Friday. Now we can see after the week ended, it's a little bit bigger this week than it was last week, implying there's a little more volatility being priced into the market than there was last week. Now, we made the edge of the week's expected move in a single day, just like we did last week. But how far we expanded outside of that range is less than what we did last week. So if you think about it, the news of DeepSync impacted the market last week a lot more than the tariff news did this week. That's probably not much consolation either, and it's making some pretty big assumptions. The DeepSync news was kind of unseen, right? It hit people, they had no idea what was going on. The tariffs talk has been all over the place, and they've had plenty of time to prepare. So it's not, like we're comparing apples to apples here, more like apples and Oreos. Still, we're trying to get back inside the week's range, and generally speaking, on a standard deviation, we're expected to close inside that range 70% of the time if it was any other market. With it being the S&P, we're expected to close inside that range 80% of the time. Having said that, we have a history with this thing that if it does close outside the range once in a while, that's fine, right? Something can't be perfect. It will close outside the range. But if you start getting repeat closes outside the range, and we're talking about a Friday's close, right? During the week, it can leave the range all at once, but it needs to close the week on Friday inside the range. And if you can find multiple examples where it didn't do that, especially if they're back-to-back examples, then it starts to be a warning or a telegraph. The market's trying to tell you something, that the volatility we're experiencing isn't getting priced into the options correctly. There's a ton of reasons for that, and this isn't really the format for it, but it's a warning, right? It's a heads up. So I don't like to count short weeks when I do this. Having said that, here's 3 weeks in a row, one of them being a short week where we closed on Friday outside that box. So as if you didn't have concern already, if you hadn't yet been concerned, this would, be the big neon flashing light that says you should be concerned. Probably don't want to do a lot of option selling on a broad basis, right? If you're doing it on an intraday or, mechanical systems, that's fine. But this is saying the juice isn't worth the squeeze, and trying to sell the premium that you see is likely going to get you run over. All right, so this is a daily chart, and what we saw happen overnight last night isn't being reflected here. But crude is up this morning, and the dollar is up this morning. but it's given it back. My concern is this is an island to the upside, just like the ES and the NASDAQ gave us that island to the downside. The problem, or at least my problem, is that the dollar looks like it wants to drop back down in a grind rather than gap back down. So it started making lows lower than what was set last night. And the NASDAQ has started making, highs higher than what was set last night. But they're not equal. This is starting to break down on the current candle that we're looking at. And it's not being matched by breakouts on the ES and the NASDAQ. If we're getting new lows here, we want to see new highs here. We're not seeing it. But it's not like back in, say, 2021, right? When every tick of the dollar up or down, we were getting an immediate reaction in the NASDAQ and the ES in the other direction. It's not like that right now. We want to use swag levels, right? Lines in the sand, like the dollar above 109. We need the dollar back down below 109. Then it's likely that we'll see a little bit of a lift in the ES and the NASDAQ. Not back to the level we left behind, because we've got some trash to deal with to get there, but that'd be a good start. There's risk of the carry trade unwind with the dollar up there like that. And since it's fading, that's going to take that risk off a little bit, not by much. We need that dollar down. We start to get a carry trade unwind, and this is going to get really ugly. Keep your eye on the VIX. Now it spiked up like the dollar did. We want to see it fall, right? But hopefully we don't see the dollar falling in a shape that looks like the VIX. Think about how the VIX gets those crazy wild spikes to the upside. And then, when it drops really fast, it leaves that crazy wick behind. We don't want the dollar looking like that. Small caps look better than the Dow, all things considered. Don't get me wrong, the Russell's down more, but just talking about the shape of the pattern here, the Russell looks a lot better than the Dow does. And so far, the 10-year is still hiding underneath that 10-day. Bitcoin down almost 10%. Mag 7 down. I mean, really, going through the things that are down would be just about everything. The bond volatility is flat. That's interesting. Remember, we started all this today talking about the bonds. Gold miners, dollar, bonds, nat gas, and the VIX are up. Now, I didn't apply my 0.5% benchmark on the gold. And be careful with gold. Gold is generally what we would consider a safe haven in times of market uncertainty, right? It's a place to hide. When you think about those guys, the funds, firms, institutions, depending on where they're at, a lot of those guys will pay a penalty if they go to cash. I know that might be hard to kind of wrap your head around, but that's just the way it is, right? So they don't want to go to cash if they can help it. Because if you are managing somebody's money and you tell them that you had to spend X amount of the portfolio paying fines and penalties because you were sitting in cash, Well, I mean, it's loss, right? It's loss, whether it's a fine or you went the wrong direction and locked in loss. I'd rather somebody lost my money because they were trying to make me money, not, hey, I lost your money because I got scared and went to cash and lost your money. So a lot of these funds and firms that don't want to go to cash, they'll just go to something else. At first blush, that is usually gold, right? That's what we see in times of crisis. They'll run to gold. Be careful with that bias, because if they were doing that, gold would be up more, right? And it's not. The other part of gold that gets tricky is margin call. So if you think about back when COVID was hitting and banks were getting a margin call, which is funny, because we think of the banks being the ones issuing margin calls to others. Banks, their collateral wasn't enough to cover their outstanding trades, and they had to come up with a lot more collateral when things were aggressively selling off. And to cover that margin, they started selling their gold. So if you go back and look at COVID, at first gold went up for a little bit, and then it started going down hard along with everything else because they were selling gold to cover their margin call. So let's be contrarian first. We'll start with the things that are up: bonds, crude, and VIX. I mean, that's not much of a surprise, right? And the dollar. So if you're looking for a tell or a signal that we're going to pause in what we're doing, maybe even reverse some of what we've gotten since last Friday's close, watch those four markets. If they start falling significantly, we could start to see a rise in the other markets. They'll be your best indicator today. All right, the VIX isn't extreme yet. Not even wild yet. So let's keep your eye on the VIX. As long as it's staying under $20, then we're just in a pullback, right? These little signs here, these little notes. David Keller from Stock Charts one day did a video on his lines and levels on the VIX that he likes to use, that he's been using for years. And they were just a really nice, simplistic approach. I mapped them out on the VIX. Is what we're looking at here. So when the VIX is above 15 but below 20, then the S&P is just in a pullback, right? It's not a correction or anything like that. It's just a pullback. If we get above 20, then we're looking at a deeper pullback, a potential correction. And of course, this has to be taken with a grain of salt because the VIX can move really fast. It can spike up and drop back down. So, we're talking about a sustained hold above 20 or a sustained hold above 15. So when we got below 15 down here and we spiked up, to 20 and a half, and we spent days working our way back down. When we do put it on a daily or a weekly, you can see that we don't generally spend a lot of time above that 20. And when we do, then it's where things start to get really nasty. That was the August carry trade unwind with the VIX spike. It went up to like 65. That's why we want to watch that carry trade today. All right, so looking at what is down the most, well, that would be Bitcoin, and then solar right behind that, and then chips, China, airlines, uranium, pot stocks in that order. So the worst hit, Bitcoin. Bitcoin's just a reflection of risk. So when you see Bitcoin going down, people are just reducing their risk appetite, really, as the best way to look at it. And solar is directly connected with China. So, China's down, solar's down. There's chips in Bitcoin. So some of this being down is because Bitcoin's down, but for a larger part of it, chips in general getting whacked this morning. And the airlines started the fall last week. They've been holding this really tight consolidation after you got to admit, that was a beautiful run. So if it starts to unravel, then you got Delta, United, American. I'd watch those three. Maybe, pick one of the three, use the other two for your indicator. Crude's up, but refiners are down, which, that makes sense because they're going to get hit. So that's what I got for you guys this morning. It's going to take a little time to dig through, what the tariffs are going to, the retaliation tariffs are going to look like. The proposals from other nations on what they're going to, apply to us. So it's not going to be solved in a day. Just keep in mind what I said at the beginning of all of this. The debt is the biggest issue, right? And even just servicing the interest on that debt. So it's not just about fentanyl and borders, and a lot deeper than that. All right, so everybody be careful, be safe, watch the clock. I'll see y'all tomorrow.